Right now, something is happening in the global financial system that most ordinary people will never hear about until it is too late. And by the time they hear about it, the opportunity will already be gone. My name is Zara, and in the next few minutes, I am going to walk you through one of the most important financial conversations you may ever have. Not because I want to scare you, not because I want to sell you something, but because I genuinely believe that the people who understand what I am about to share will look back on this moment as a turning point in their financial lives. Let me start with a story. A few years ago, I knew someone who worked incredibly hard. A middle-class professional, decent salary, a small savings account, a pension he had been contributing to for over a decade. On the surface, everything looked fine. He was doing what he had been told to do his entire life. Save your money, trust the system, work hard, and the future will take care of itself. Then one day, he sat down and did something most people never do. He actually looked at the real numbers. Not the balance in his account, not the number printed on his payslip, but the purchasing power numbers. He calculated what his savings could actually buy him compared to 10 years earlier. And what he found quietly shattered something inside him. His account balance had grown, but what that money could actually purchase had shrunk. The numbers went up, but his real wealth went down. That is not a personal failure. That is by design. And understanding that design is the first step to protecting yourself from it. Today, I want to talk to you about silver, about the dollar, and about the quiet, steady signals that are flashing right now in the global economy that most people are either ignoring or do not know how to read. The title of today's conversation asks a bold question. Silver to $500? Dollar collapse signals flash? Before you dismiss that as dramatic, I want you to do one thing. Suspend your assumptions for the next few minutes. Not forever, just long enough to examine the evidence with honest eyes. Because the biggest financial mistakes people make are not made out of stupidity. They are made out of closed minds. So let us begin at the very beginning. What is money? Most people think money is the paper in their wallet or the number on their phone screen. But that is not what money is. That is what money looks like. What money actually is, at its core, is a store of value, a tool that allows you to exchange your labor today for goods and services tomorrow, a bridge between your present and your future. And for most of human history, that bridge was built on something real, something physical, something that could not be printed or created out of thin air. For thousands of years, gold and silver were money, not because governments decided they should be, but because human beings across every culture and every civilization independently arrived at the same conclusion. These metals are rare enough to hold value. They are durable enough to survive time. They are divisible enough to be used in everyday trade. And they are trusted across every border. That is not a coincidence. That is the accumulated wisdom of human experience across millennia. Now here is where the story changes. In the 20th century, governments around the world gradually removed the direct link between their currencies and physical precious metals. The final break came when the United States officially ended the convertibility of the dollar to gold. From that moment forward, the dollar became what economists call a fiat currency, backed not by something physical and limited, but by trust, by decree, and by the promise of the issuing government. At the time, many called this progress, flexibility, the ability to manage the economy more precisely. But very few people ask the important question. What happens when trust erodes? What happens when the debt grows so large it can no longer be sustained through productivity alone? What happens to the ordinary person whose entire life savings sit inside that fiat system when the cracks begin to show? These are no longer hypothetical questions. These are the questions the current moment is demanding we answer. And silver, of all things, may be one of the most important answers available to ordinary people right now. Not because it is glamorous, but because it has been doing its job as a store of value for longer than any currency in circulation today has even existed. Every single paper currency in human history has eventually failed. Every one. But silver has never gone to zero. That is not a small thing. That is everything. In part 1, we talked about the nature of money and what fiat currency actually means for your savings. Now I want to get specific. What are the real signals flashing in the financial system right now? And how do you read them before the headlines start screaming about them? Because by the time the headlines are screaming, the preparation window is already closed. Let me walk you through 4 key signals. Clearly, calmly, one at a time. The first signal is sovereign debt. When a government consistently spends more than it collects, that debt compounds year after year. At some point, a tipping point arrives. The government can no longer grow its way out. It cannot tax its way out without destroying the economy. So it is left with one primary option. It inflates its way out. It allows the purchasing power of the currency to quietly erode, which makes the real value of its debt smaller over time. This is not a new strategy. It has been used throughout history. And ordinary savers always pay the price. As the government's burden shrinks in real terms, the real value of your savings shrinks right alongside it. This process is already underway. The question is only about the speed at which it accelerates. The second signal is money supply expansion. When a central bank creates new money, it dilutes the value of every existing unit of that currency. Think of it simply. If you own one share in a company that has issued 100 total shares, you own 1%. If the company overnight issues another 100 shares, your share still looks the same. But your real ownership has been cut in half. That is exactly what happens to your savings when the money supply expands rapidly. More money chasing the same goods and services means each unit of money buys less. That is not an opinion. That is arithmetic. The third signal is de-dollarization. For decades, the dollar held a unique position as the world's primary reserve currency. When countries traded with each other internationally, they largely did so in dollars. This created a consistent global demand for dollars, which supported the dollar's value and stability. But a quiet, significant shift has been taking place. Countries around the world have been gradually reducing their reliance on the dollar for international trade. They have been signing bilateral agreements in their own currencies. They have been reducing dollar reserves. They have been exploring alternatives to the dollar-dominated system. This process is slow, but it is real and it is measurable. Because if global demand for dollars decreases, the structural support for the dollar's purchasing power decreases with it. More dollars in circulation and less global demand for those dollars. You do not need an economics degree to understand what that means over time. The fourth signal is the behavior of central banks themselves. Here is something that rarely gets discussed but is enormously telling. Central banks, the very institutions that issue and manage fiat currencies, have been quietly buying gold at a pace not seen in decades. Not more dollars, not bonds, physical gold, the oldest form of money in human history. Ask yourself one simple question. Why would the people who print money, the people most invested in the credibility of the fiat system, be quietly accumulating the one asset that is essentially a hedge against that system failing? That question answers itself. Now, why silver specifically? Because silver is historically undervalued relative to gold. There is a measure called the gold-to-silver ratio, which tells you how many ounces of silver it takes to buy 1 ounce of gold. Over thousands of years of market history, this ratio averaged between 15 and 20 to 1. Today, it sits dramatically higher than that historical average, which means, by any long-term standard, silver is significantly undervalued. But silver has something gold does not have in the same proportion: industrial demand. Silver is a critical industrial commodity, used in solar panels, electronics, electric vehicles, medical equipment, and hundreds of advanced technology applications that are not going away. As the global economy shifts toward renewable energy and advanced technology, the industrial demand for silver is expected to grow considerably. So you have a metal that is historically undervalued as a monetary asset, experiencing increasing industrial demand, and accessible to ordinary investors at a price point gold simply cannot match. That combination does not come along often. And when you layer the currency signals we just discussed on top of that foundation, the long-term case becomes very clear to anyone willing to look at it honestly. I want to open with something that might surprise you. Most people who correctly understand the silver thesis still end up hurting themselves financially. They understand the why, but they get the how completely wrong. And in investing, getting the how wrong can be just as damaging as missing the opportunity entirely. Let me walk you through the most common and most costly mistakes. Not to discourage you, but because real education does not just show you the door, it helps you walk through it without tripping. The first mistake is what I call the panic buyer trap. When someone genuinely understands currency debasement for the first time, a natural emotional urgency kicks in. A feeling that every dollar sitting in savings is burning, that they are behind and need to act immediately and completely. This emotional state is understandable, but it is dangerous. Converting 100% of your savings into silver overnight, based on information consumed over a weekend, is not a financial strategy. It is an emotional reaction dressed up as one. And emotional reactions, even when triggered by accurate information, almost never produce good long-term outcomes. Here is the truth about any asset, including silver. Even if the long-term directional thesis is completely correct, the price path is never a straight line. There will be significant volatility. There will be periods where silver drops sharply. There will be months, possibly years, where it appears the thesis was wrong. And if you have put everything in during a moment of urgency, you will not have the psychological stability to hold through those difficult periods. You will panic sell at a loss. And then watch it recover without you. Being right about the direction, but wrong about the positioning, is one of the most painful experiences in investing. Discipline is not the opposite of conviction. Discipline is what allows conviction to survive long enough to be rewarded. The second mistake is chasing prices. When silver rises rapidly and makes headlines, everyone suddenly wants to buy it. When silver is quiet or declining, no one wants to discuss it. Human psychology is wired to want what is going up and avoid what is going down. In life, that instinct protects us. In investing, it reliably destroys us. The best time to build a position in any asset is when no one is paying attention to it, when the crowd is bored by it, when it is undervalued and overlooked. The crowd catches on later, and by then, the people who were early have already done the real work. The third mistake is confusing paper silver with real silver. When people first enter the silver market, they often gravitate toward the most convenient options: silver ETFs, futures contracts, mining stocks, digital silver certificates. These products have their place for certain types of investors, but they are not the same as holding physical silver. Not in purpose, not in risk profile, not in what they actually represent. If the primary reason you are considering silver is protection against currency instability and financial system stress, then a paper certificate that promises you silver but is held within that same financial system provides far less protection than you might think. In a genuine crisis, the institutions holding your paper silver face their own pressures. The whole point of physical precious metals as a financial hedge is that they exist outside the system you are hedging against. Understanding the difference between paper exposure and physical ownership is not a small technical detail. It is fundamental to whether your strategy actually achieves its purpose. The fourth mistake is neglecting everything else. Silver is not a complete financial strategy. It is one component of a thoughtful, diversified approach to long-term wealth preservation. The person who puts all their focus and resources into a single asset, even a compelling one, has simply replaced one form of vulnerability with another. A sound financial foundation still requires emergency liquidity. It still requires income-producing assets. It still requires an honest assessment of your personal financial situation, your time horizon, and your actual risk tolerance. Silver fits within a strategy. Silver is not the strategy itself. We have covered the signals. We have covered the mistakes. Now I want to talk about something deeper. The mindset that separates people who successfully navigate financial uncertainty from those who are continuously caught off guard by it. Because here is what I have observed over years of thinking about these questions. The difference between financial resilience and financial fragility is rarely about information. Most people have access to roughly the same information. The difference is almost always about mindset, about how someone frames their relationship with money, time, and uncertainty. Let me share the first principle. Wealth preservation is not the same as wealth creation, and confusing the two is expensive. In periods of economic stability and growth, the focus of financial thinking is naturally on creation. Building, growing, expanding. Returns on investment. Compounding growth. And that focus is entirely appropriate when the environment supports it. But in periods of genuine monetary instability, the priority shifts. Protecting what you have built becomes more important than aggressively building more. Because you cannot compound from zero. You cannot recover what you never protected in the first place. The investor who ends a turbulent decade with their purchasing power intact, even if they did not dramatically grow their wealth, has outperformed the investor who chased aggressive returns, suffered large losses, and spent the following years simply recovering to their starting point. Preservation is not a passive or timid strategy. In the right environment, it is the most intelligent strategy available. The second principle is thinking in decades, not months. One of the most consistent patterns in financial history is that the people who accumulate real, lasting wealth are the people who think in very long time horizons. They are not asking what silver will do next quarter. They are asking what silver will represent relative to fiat currency over the next 10 or 20 years. They are not reacting to weekly price movements. They are positioning for structural shifts that take years to fully unfold. This is psychologically difficult in a world that provides constant, real-time financial information. Every price movement feels significant. Every piece of news feels urgent. The noise is overwhelming, and most people are completely unable to distinguish the noise from the signal. The discipline to maintain a long-term perspective in a short-term world is genuinely rare. And like most rare things, it is genuinely valuable. The third principle is understanding the difference between price and value. Price is what the market says something is worth at any given moment. Value is what something is actually worth based on its fundamental characteristics. These two things are related, but they are not the same, and the gap between them is where every real investment opportunity exists. When silver is ignored by the mainstream, when the crowd is focused elsewhere, when the financial media has nothing exciting to say about it, the price may not reflect the underlying value. The signals we discussed in Part 2 are value signals. They speak to what silver represents fundamentally in a world of expanding money supply and currency uncertainty. They do not tell you what silver's price will be next Tuesday. The investor who understands value can hold patiently through periods when price and value are disconnected, knowing that over sufficient time, price tends to converge with value. The investor who only understands price reacts emotionally to every movement and almost always ends up buying high and selling low. The fourth principle is that preparation and prediction are not the same thing. You do not need to predict that the dollar will collapse to justify building meaningful exposure to silver. Prediction requires certainty. Preparation only requires probability and wisdom. If there is a meaningful probability that the purchasing power of fiat currencies will continue to erode, which the evidence strongly suggests, and if silver represents a historically proven store of value that is currently accessible and undervalued, then building a measured position in silver is simply prudent preparation. You are not betting everything on a single dramatic outcome. You are acknowledging that multiple possible futures exist, and you are positioning yourself to navigate more than one of them successfully. That is not speculation. That is wisdom. The fifth principle is financial education as a continuous practice. The biggest long-term investment you can make is not in silver or gold or any specific asset. It is in your own financial understanding. The person who deeply understands monetary systems, currency history, asset valuation, and economic cycles will make better decisions across every financial context they ever encounter, for the rest of their life. Assets can be taken, markets can move against you, economic conditions can change in ways no one anticipated. But genuine financial literacy, the kind that comes from honest, patient, rigorous study, stays with you regardless of what the market does. The most financially resilient people I have ever observed are not the ones who made the best single trade. They are the ones who built the deepest understanding, who could adapt when circumstances changed, who were never entirely dependent on a single outcome going their way. That is the mindset we are building here. Not a tip, not a trade, a foundation. Welcome to the final part, and I want to begin this part differently. I want to begin with a warning, a sincere, direct, honest warning that I believe every person watching this needs to hear before they take any action based on what we have discussed today. The warning is this. The information in this video is the beginning of a conversation, not the end of one. What I have shared with you today is a framework for thinking, a set of signals worth examining, a perspective that serious long-term thinkers are paying attention to. It is not a personalized financial plan. It is not advice tailored to your specific circumstances, your income, your existing obligations, your family situation, or your psychological relationship with risk and uncertainty. Anyone who watches a single video, regardless of how thoughtful that video is, and then makes large, irreversible financial decisions based entirely on that video is not investing. They are gambling. And they are gambling with something far too important to treat carelessly. Your financial life is not a test. You do not get unlimited attempts to get it right. The decisions you make with your money have real consequences for you and for the people who depend on you. Those decisions deserve real time, real research, and, if appropriate, the guidance of a qualified professional who understands your complete financial picture. That warning is not a disclaimer. It is genuine care. I would rather tell you something uncomfortable that protects you than tell you something exciting that hurts you. Now, with that foundation clearly in place, let me give you what I believe is the clearest, most honest summary of everything we have discussed across these 5 parts. We are living through a period of genuine monetary transition. The signals are measurable, and they are real. Sovereign debt at historic levels, rapid expansion of the money supply, the beginning of a structural shift away from dollar dominance in global trade, and the behavior of central banks themselves quietly communicating that not even the architects of the fiat system are fully comfortable relying on it alone. Silver sits at the intersection of 2 powerful forces. It is a monetary metal with a 5,000-year track record as a store of value, currently undervalued by historical standards relative to gold. And it is an industrial commodity whose demand is growing alongside the global shift toward renewable energy and advanced technology. The case for silver over the long term is not built on hope or speculation. It is built on the fundamentals of supply, demand, and the historical behavior of fiat currencies, under the conditions we are currently observing. A price of $500 per ounce for silver would represent a significant move from where it trades today. Is that guaranteed? Nothing in investing is guaranteed, but is it within the realm of historical precedent when you consider what similar monetary conditions have produced in past cycles? Absolutely yes. The question is never whether a particular outcome is certain. The question is whether the risk-reward profile, the balance between what you might lose and what you might gain, justifies a measured, disciplined, long-term position. And for ordinary investors who want meaningful exposure to hard assets, who want a component of their savings to exist outside the fiat currency system, who want the combination of monetary protection and industrial demand growth in a single, accessible asset class, silver makes a compelling case. But let me be clear about what compelling means here. It means worth serious study, worth honest consideration, worth discussing with someone who understands your financial situation completely. It does not mean liquidate everything and act immediately. It does not mean ignore your other financial obligations. And it absolutely does not mean trust any single source, including this one, as your complete investment thesis. The most important thing you can take from today is not a conclusion. It is a direction toward deeper understanding, toward asking harder questions about the money you hold and what it actually represents, toward building a financial literacy that serves you across decades, not just in this moment. Because the window we are discussing is not a single day or a single week. The structural trends we covered today have been building for years, and they will likely take more years to fully play out. You have time to learn. You have time to be thoughtful. You have time to build a position slowly, carefully, and wisely. But you do not have unlimited time, and the people who spend the next 5 years meaning to look into this, intending to do the research, planning to think about it seriously, will wake up one day to headlines that confirm everything we discussed today, and they will wish they had spent 1 hour a week for the past 5 years building their understanding instead of their regret. Start now, but start slowly. Start thoughtfully. Build your knowledge before you build your position. Understand what you own before you own it. Know why you are holding it before you hold it. That is the discipline that separates investors from gamblers. That is the mindset that builds wealth that actually lasts. I am Zara, and today's conversation was never really about silver or the dollar. It was about you, about your future, about the kind of financial thinker you choose to become starting from this moment. The signals are flashing. The window is open. What you do with that information is entirely up to you. Choose wisely, move slowly, think long, and whatever you decide, decide it with your eyes open.